Bloomberg's mini-weekly documentary, they're asking that important question: how will foreign investment help develop those African nations? I want to stay with that subject, perhaps even answer that question. The World Bank saying Africa has gone through a, quote, lost decade as debt payments and lack of access to capital take resources from education, health, as well as the environment. IMF data as well showing African nations' debt to GDP ratios have doubled since 2013. I want to bring in a true expert, Bloomberg's Africa economist, Yvonne Mahango, live for us in Johannesburg this morning. Yvonne, good morning from London. Yvonne, when we're talking about these several African countries being highly indebted, what does that actually look like?
So we've seen several African countries build up their debt over the past 2 decades, and as a ratio of GDP, debt has increased to over 60% of GDP. We have half of Africa's countries, low-income countries, considered to be at high risk or already in debt distress as a result of this significant increase in lending. A lot of it's from new lenders, particularly China, as has been mentioned earlier, as well as bondholders. We're in a situation where countries have defaulted since the pandemic. In particular, Zambia and Ghana have defaulted on their debt, and more recently, it looks as though Ethiopia will also be defaulting on its Eurobond payments. Looking into 2024, the next country that's being watched is Kenya, because they've got a sizable Eurobond payment due in June of $2 billion. We're also in a situation where we've got at least 8 African countries that are seeking to restructure their debt to avoid defaulting on their debt.
But this feels like at its core, it is a little bit of a liquidity story, where I felt like a couple of years ago, so many people wanted that exposure to frontier nations, specifically on the African continent, competing even with the likes of China, as we discussed in that documentary. Now, very much a funding squeeze. Why that transition?
The change in U.S. interest rates. So prior to the pandemic, we had low interest rates, we had high global liquidity chasing yields, and a lot of that liquidity came into Africa and helped finance the infrastructure projects that we're seeing on the continent. But of course, over the past 2 years, we've seen a sharp increase in U.S. interest rates. It's made it harder for African countries not just to raise foreign financing for their budgets, but also to refinance their debt. We haven't had a sub-Saharan African country issue a Eurobond since the beginning of 2022. And that's one of the challenges for countries that are due to repay debt over the next couple of years, is that they're struggling to refinance that debt. So you're finding that there's tight foreign exchange liquidity throughout their continent, and that's contributed to the depreciation of currencies. The Nigerian naira, Malawian kwacha have depreciated by 50% this year, the Kenyan shilling by almost 30%, and the Angolan kwanza by 40% due to this sharp decline in foreign exchange liquidity.
I mean, liquidity around the world is truly already starting to see that crunch, of course, magnified in those African nations. Bloomberg's Africa economist Yvonne Mahango. We have to leave it there. We thank you so much joining us live from Johannesburg. Plenty more ahead. Stick with us. This is Bloomberg.
The relationship between tourism and nature has always been a very important relationship. But unfortunately, it has been always a negative relationship where one is thriving over the other. We need to change the fundamentals of how we are approaching things. What HC Global is trying to do is have a very different approach. We believe that tourism does stand a very good chance as an industry to be the role model, to demonstrate to the world how things can be done differently. The scientists were the first people we engaged with for the development of this project, to make sure that we enhance our understanding of the environment and the habitats that are here in the location. This is our first 1 million mangrove seedlings that are now making their way to their plantation site on the islands and on the coast. You see the crab? Just went into its hole. Those crabs were not here. And they're here now because of the mangrove nursery. That's how we know that we have created a viable habitat for those crabs. And now those crabs are attracting the birds. Regenerative tourism is everybody within the whole system taking part in regeneration, where the guests will be part of that regeneration. guests will be able to contribute to that regeneration, not only enjoy it when they come out of their rooms on the islands. And this is how we're keeping a connection with the local community. They're employed everywhere within the company. And this is because we need to learn from them and we need to work with them in order for this tourism destination to succeed. The designers and the engineers are building wonders, and the people on the environmental and sustainability side are teaming up with them at every single stage to make sure that we deliver it in a way that is the Red Sea way.
We've had a lot of discussion post-Brexit of people, banks, operations potentially moving out of London, but it hasn't materialized on anything like the scale that people predicted. London has shown itself to be very resilient. And if you look at what's happened in the last year, what we've done in the UK is we've shown we're going to be hungry to keep all that business that's come to London. We are very committed to financial services in the UK. We passed the Financial Services and Markets Act. We are changing the rules for prospectuses and for all sorts of the rules around IPOs to make the London Stock Exchange more competitive. We've got the Mansion House reforms, which is going to unlock a lot of capital into growth businesses from pension funds. So we are really motoring in the UK. We're hungry to attract business all around the world. And this deal with Switzerland is just another step in that direction.
How much are you looking to some of these revenues, though, to be able to enact tax cuts? You were talking about additional tax cuts coming down the pike. Are you still planning that? And specifically, where are you planning to have those tax cuts? Is it going to be with the savings or property, other areas?
Well, Rishi Sunak and I have said that we would like to cut the tax burden more if we're able to do so. But we won't be in a position to do that until much closer to the spring budget. We haven't announced a date for that yet. But, you know, we won't find out what the latest forecasts are from the Office of Budget Responsibility to know whether we're in a position to do that for some time. But we would like to bring down the tax burden in a way that is responsible if we're able to do so. But right now, our priority is to bring down inflation.
UK Chancellor Jeremy Hunt there speaking with our very own Lisa Abramowitz yesterday about a really crucial turn in perhaps the health of the UK financial services. And sticking with that story, I want to bring you some of the news around a major deal. Harbour Energy has announced an $11.2 billion deal to buy the upstream assets of oil and gas producer Wintershall. The blockbuster acquisition would give the UK energy producer exposure to markets specifically from North Africa, as well as to the Americas, as well as carbon capture and storage licenses in Europe. Now, Harbour stock price in London jumped as much as 35%, hitting the highest level since January and making this combination the largest oil and gas producer in the UK. That's pretty significant there. In the meantime, the EU Court of Justice has ruled that UEFA and FIFA violated antitrust law by thwarting plans for a football European Super League. The decision follows a judgment from a Spanish tribunal that warned them not to interfere in preparations for a breakaway league. But despite the rulings, it's unlikely that any new league will materialize, at least in the short term, with clubs including Manchester United and Bayern Munich still opposed to the move. Now, coming up on the program, we're diving into Japanese inflation. And yes, it is in line with expectations, but we're going to talk about what it means for the BOJ and the world's last negative rate. Stick with us. This is Bloomberg.
He's all taller than me. I'm on my tiptoes here.
Welcome to the Axis Select Your Edge Challenge. With Axis Select, Axis Capital Allocation Program, traders can access up to $1 million in funding. What difference did having the Axis Edge make for you guys?
To have that Axis Edge gives you a little bit of security, knowing that, you know, you've got an advantage over your opponents.
What's more, you get to keep up to 90% of the profit.
Axis, trade your edge.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Good morning and welcome to Daybreak Europe. I'm Kriti Gupta in London. Let's get to the top stories that set your agenda. Markets mixed among thin holiday volume. U.S. core inflation data is going to be the real focus point today as that soft eco number adds to the case for rate cuts. Meanwhile, over in Asia, China cracks down on an online gaming yet again, while slowing Japanese inflation puts the spotlight on the BOJ. Plus, in the corporate space, Nike missing estimates and issuing a warning on the Chinese consumer. Those shares falling after hours in the U.S. session. I want to get a quick check on the markets from around the world, truly, because like I said, it is thin holiday volume. When you look at the futures trade right now, you're seeing a sea of red. Now, what's interesting here is that, of course, it's the last day before the Christmas holiday, and of course, going to see a very, very thin holiday volume in next week as well, even thinner than the one you are seeing right now. But I think the real takeaway here is that a lot of people are taking cash off the table, specifically after yesterday's session where there was a little bit of bottom feeding, and that's pretty normal to see during this holiday season, although there are a lot of questions about where that Santa rally actually went. Nevertheless, Eurostoxx 50 futures down about 0.1%. Some real underperformance right here in the UK. We have FTSE 100 futures down about 0.2%. Across the Atlantic, a similar story. You are seeing risk off really set the tone around the world. I want to get the cross-asset story as well. When you look at this bond market, though, take a look at the 10-year yield. It is at 3.89, virtually unchanged right now, but I still think it's significant that it is staying below that 4% level, even though we're talking about slight kind of steadiness, for lack of a better term, in the bond market. The FX market is a completely different story. If you look at euro dollar today, it actually hit 110. So again, new strength in euro and the pound, I might add, 126 there as well, as we continue to see that dollar weakness story kind of fuel some of these other currencies around the world. What's interesting to me, though, is that that dollar story is not translating as much to the oil one. And Brent crude trading about an $80 handle, higher actually by 0.8%. Now, a lot of news there. We're talking a lot about the Red Sea and the repercussions there. We also heard in the last 24 hours that Angola, a nation that hasn't actually been able to meet a lot of their supply quotas, is actually now leaving OPEC+. We're going to dive into in a couple of hours ahead where we are going to see the actual pain points in that oil story. And of course, there are pain points not just in oil, but in the Chinese gaming business as well. This is something that has global repercussions. We know the crackdown from China into some of these tech names has been enormous as we talk about what kind of impact it might have on the Chinese youth. At least that's the line coming out of the Chinese government at the moment. But take a look at the pain trade you are seeing over there right now. The Hang Seng down about 1.6%. Tencent, for example, has dropped pretty substantially, down 14% in that trade. That's going to have repercussions for all the gaming companies around the world. You just wait till some of those American companies start trading in the pre-market. That is your China story, but I want to go to the Japanese one, where inflation slowed as expected, with core consumer prices rising 2.8% year over year. This all while services showed signs that underlying price growth spreading pretty widely in the economy. Joining us for more is Bloomberg's Japan and Korea economy and government reporter Paul Jackson. He is all over this story. Paul, let's start with the inflation data specifically. We know that Japan hasn't exactly had the best luck with inflation for decades, and all of a sudden seems to be really shooting much higher than their long-term inflation target. What is the key takeaway from today's data point?
Well, I think the key takeaway is that we've seen inflation edging down as expected, but it's still above target. This is the 20th month we've been 2% or more, which is the decades-long goal of Japanese policymakers. So the question has to be asked, when will the Bank of Japan ease off its stimulus measures? I think if we dig deeper into the data, although it's cooling down, some people might think, hey, the Bank of Japan doesn't need to back off. Well, inflation's cooling down. But if we look into the numbers, we'll see that service prices are rising at 2.3%. That's the highest since the early 1990s, give or take a few tax effects during the intermittent years. And I think what we are needing to get ready for is the idea that they will scrap this last remaining negative interest rate in global banking. So the question really is when. Now, if we got a cooling, you could argue that, oh, well, they can wait a bit longer, can't they? But I don't think we should be rushing to push back our rate hike bets. The consensus is still really that they will move by April, with April and January being the favourite months for a move. So what more does the Bank of Japan need to see? Well, one of the things that's been keeping it stimulating the economy with these measures, including its bond buying and this negative interest rate, is the lack of wage increases. The Bank of Japan wants positive inflation that's good for the economy. And to do that, it wants to see wage growth, and it's getting wage data in March. And that's maybe one of the key factors that is making economists think that maybe April is the most likely month for it to scrap the negative interest rate.
I mean, that's at its core the criticism that the rest of the world is saying, is that not all inflation is created the same. And I think that was the first initial criticism